Frustrated by drawdown? Struggling to keep your investment growing? Well, in this video, we uncover a remarkably simple technique that enhances returns and reduces drawdown. Whether you're a passive index investor or a more active trader, the simplicity and effectiveness may surprise you. As traders, we often look for complexity in order to solve the markets, me included. However, in this video, we demonstrate precisely the opposite, leaving many wondering why they've not applied the technique themselves. Before we get into the detail, let me show you some of the major market declines which were avoided. Let's start with a dot-com bubble in the year 2000. Using the S&P 500 as our benchmark, we can see how the index dropped by more than 50% from its peak. Our simple rule would have seen us exit the markets here, whilst re-entering after the market bottom. The drawdown, misery, and even opportunity cost during this period would have been significant. In some situations, the losses were sadly too much to bear. A similar situation occurred in 2008, widely referred to as the Great Financial Crash. Again, using the S&P 500 as the benchmark, we can see how the market dropped by a near 57% from its peak. We would have exited here and only re-entered after the market bottom had occurred. Can you imagine losing more than half of your investment in just over a year? Or perhaps even worse, being just moderately leveraged would have seen many lose everything. How about in more recent times? In 2022, financial markets became fearful from the events in Ukraine and the resulting rise in inflation. The S&P 500 took a volatile move down, losing around 27% of its value from the peak. In fact, many funds, including the likes of Cathie Wood's ARK Innovation, lost in excess of 70%. However, using our method against the S&P 500, we would have exited the equity markets, including Cathie's fund, here, and only re-entered early in 2023, saving us again from considerable drawdown, heartache, and opportunity cost. The method we use? It's the 10 and 20 Exponential Moving Average Crossover. It sounds a mouthful, but its application is very simple indeed. Before looking at the method, longer-term returns, and the impact it has on my own equity curve, please consider hitting the like button. And for those new to the channel, why not subscribe to our growing stock market content? Ranging from singular strategies through to research studies, I also offer my own strategy born from over 30 years of market experience, as well as an active forum and a bespoke breakout scanner. Let's look at the crossover method in action. On almost all charting and brokering packages, you will see an option to add many indicators. And in this example, we select the Exponential Moving Average indicator. We're then presented with an option to add our settings, and we add 10 and 20 into each of the boxes. We apply this to the S&P 500 weekly chart and get the following presentation. We can see the dot-com period, and not far from the peak, we get a confirmation of the 10-week moving average crossing below the 20-week moving average, marking a great time to exit the equity markets. An exponential moving average is a line that measures the average movement of price over a set period, smoothing out much of the noise, without the need to look at the price action. Throughout our method, we use the weekly chart. Therefore, the 10 EMA measures the average price movement of the previous 10 weeks. Unlike a simple moving average, however, the exponential moving average places more importance to more recent price movements, therefore helping us to react faster. Using a moving average crossover means that we can have a mechanical method of entering or exiting the market, regardless of news or the noise of price action. Imagine how much calmer you would have been during both the dot-com bubble and the Great Financial Crash by simply using the method. No huge drawdowns, whilst still benefiting from the bulk of each recovery. Let's put all of this together before we move on to some backtest analysis. Firstly, we use the S&P 500 index whilst viewing it on the weekly timeframe. We overlay the 10 and 20 EMA indicator, and we look for the crossover in either direction. We then have two choices. We can either buy into or exit the index based on the crossovers. Or we can associate the crossovers with a trading window, therefore only applying a strategy when we get confirmed trading windows. Either approach has proven to be very beneficial. However, let's start with a backtest of buying and selling the S&P 500 index first. To demonstrate how effective this approach is, we should first understand how difficult it is to beat the index. Remember, the S&P is made up of the 500 largest companies in the US. A recent study by Forbes determined that actively managed funds, including pension funds and mutual funds, were largely unlikely to outperform. In fact, over a 10-year period, only around 8% of funds would beat the index. If, however, the 92% of underperforming funds were simply to use this crossover method, they would have been considerably ahead. The blue equity line represents account growth from buying and selling the index at the crossover. The orange line is a simple buy and hold approach. It's a shame we couldn't go back further than 2002 to cover the dot-com crash. In doing so, we would have seen an even bigger improvement. The main observations from the backtest is the avoidance of drawdown in 2008 and in 2022. The crash due to the pandemic was hard for any strategy to avoid due to its speed. Nonetheless, the largest drawdown was 24% over the backtest period, less than half of that of the buy and hold approach. And for an index that is statistically hard to beat for the most highly paid fund managers, it fared very well. Such an approach could just be a foundation to build upon further. For example, if we also added in a 12% trailing stop to the crossover approach, the performance would be enhanced further. More noticeably, the reduced drawdown of 16%. It's quite feasible to suggest that with a low drawdown, you could apply leverage to the approach. If, for example, you are willing to accept twice the drawdown, you could consider a leverage factor of 2 to 1, therefore doubling the annual returns and significantly improving the compounding effects. The reason for my analysis, however, was to improve upon my own breakout strategy. In light of 2022 and the market's erratic move down, I wanted a broader market timing model which would offer the right environment to apply my approach. We can see here that the 10 EMA crossed below the 20 EMA early in the year and never crossed back up until early 2023. It's a simple timing model that provides windows of opportunity to apply strategies, and of course, periods when we should not. Avoiding drawdown is of course only one part of the equation. I also wanted to determine if the timing model had any negative impact on my strategy as a whole. The impact was pleasingly minimal. Other than a slight variance from a small batch of trades, the broader market timing model all but eliminated the 2022 losses, remaining in cash for the most part. Needless to say, the PDF has been updated to include the model. For those interested in the crossover approach as a standalone strategy, let's revisit some backtest studies. How about the Nasdaq? Well, buying and selling at the crossover would have meant outperformance over a buy and hold approach, not with the same degree of safety as using the S&P, but nonetheless outperformance. Again, it's unfortunate the backtest was limited by date. Had we seen the dot-com crash, the outperformance would have been huge. We can, however, see the crossover in action during the crash. We look for the 10 and 20 EMA crossover on the weekly Nasdaq chart, and by doing so, we would have been in the index on the way up and out of the index for the bulk of the move down. How about FANG stocks? FANG stocks are comprised of the 5 most popular tech companies, and in this backtest, we use 20% against each of the 5 stocks, whilst again entering and exiting on the 10 and 20 EMA crossover. We can see the average annual return of 17.3% over the 23 years, with a maximum drawdown of 32%, an improvement on the 66% drawdown we would have seen if we simply held the Nasdaq over the same period. The 100,000 investment would have turned into 2.6 million, way above buy and hold. Aside to a standalone approach, for me the revolution is within its simplicity and the ability to provide a timing landscape in which to apply a trading strategy. By avoiding the application of a long approach in the red areas when the 10-week EMA has crossed below the 20-week EMA, we greatly improve the probability of success. Similarly, if you applied a dollar-cost averaging approach against the S&P index, you might want to only add funds during the green windows and return to cash during the red. Regardless of your preferred approach, it's not only the cost of drawdown. It's the psychological impact and the opportunity cost of tying capital up for prolonged periods. Remember, you don't need complexity or highly paid fund managers to beat the index, and you certainly don't need to fight the trend of the broader market. It is, however, wise to remain adaptable, open to change, whilst being thorough in your analysis.